In this short video, we are going to explain the securitized banking sector and outline its role in the 2008 financial crisis. We will then describe how the Basel Committee proposed new regulation changes to ensure this would not occur again. First, let's take a look at credit risk. Credit risk is the risk of default on a debt that may arise from a borrower failing to make required repayments. We are particularly interested in the risk of default between financial institutions in the fixed securities repurchasing market, or repo market for short. Repurchase agreements, also referred to as repos, are money market instruments where a dealer sells a security and repurchases it within a small period of time, often the very next day. The next component is securitization. This refers to the pooling of contractual debt and issuing their related cash flows to third-party investors as securities. When repos and securitization were combined, they formed the foundation of the securitized banking sector, where asset-backed securities were bundled, sold, and repurchased. We are now going to look at a particular branch of this sector, the subprime mortgage market, and its role in the financial crisis. To introduce the concept of the mortgage bond, I am now going to hand you over to my good friend Brian Gosling.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAA is getting paid first, the lowest rated B is getting paid last, taking on defaults first. Now, obviously, if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash? Behind you. I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close.
These mortgage bonds were called collateralized debt obligations, or CDOs for short. They are significant as they depend heavily on the repo market and are especially vulnerable to subprime credit risk. Now we will look at the incredible rise of repo activity in the lead up to the crisis. Throughout the 1960s and 1970s, the use of repo agreements became a popular tool of state governments and corporate treasurers to manage their money. Their use continued to grow until 2006, at which time the average cash held by a firm had doubled since 1980. The growth of securitized banking is evident in the significant increase in value of investment bank assets in comparison to commercial bank assets, a ratio that has grown from 5% in 1990 to 25% in 2007. The fallout of the crisis can be exhibited through two pertinent variables, the ABX index and the LIBOR-OIS spread. The ABX index, a credit derivative that essentially proxies for the level of subprime credit risk in the market, went through a steady rise throughout 2007 and 2008. In that time, it rose from 153 basis points to 9,000 basis points. Meanwhile, the LIBOR-OIS spread, which represents counterparty risk and market liquidity risk in the interbank repo market, endured two massive hikes. The first one was in August 2007, and this was then followed by another in September 2008, in unison with the failure of Lehman Brothers. The extraordinary inflation displayed in these two variables conveys the underestimation of subprime risk in the financial industry, and particularly the effect it subsequently had on counterparty risk in the repo market. These shocks stirred fears of illiquidity in the fixed security market, causing a run on the repo, where parties sought to withdraw from their repurchase agreements, as evident in the excessive repo haircuts during the crisis. From this, we can conclude that the securitized banking sector played a major role in the crisis by selling mortgage securities to investors with little knowledge of the subprime risk contained within the bonds. When it finally came to their attention, it caused widespread panic and a large amount of withdrawals within the repo market. Market liquidity dissipated and the fixed income security market collapsed, bringing about the worst financial crisis since the Great Depression. The securitized banking sector was one of the main reasons for the turbulence in the financial markets. To avoid this problem occurring in the future, the Basel Committee came up with new regulations. The Basel Committee on Banking Supervision, shorted as BCBS, provides a forum for regular cooperation on banking supervisory matters. It was established in 1975 by the central bank presidents of the G10 countries. The financial crisis exposed the weaknesses of the overall design for capitulating trading activities. To strengthen this design and decrease the chance for another crisis, the Basel Committee presented Basel III, which includes a set of new regulations. Minimum capital levels were raised. The quality of capital required was improved to make sure that capital was genuinely loss absorbing. The non-risk-based leverage ratio was introduced. The liquidity coverage ratio was introduced. The net stable funding ratio was introduced. The new capital charges should capture risk of changes to credit valuation adjustments, CVAs. According to these new rules, banks are required to account for changes in the credit spreads of their counterparties on CVAs for all over-the-counter derivatives that are being dealt with. This can be achieved by using standardized or advanced CVA approaches. Thus, banks cannot sell unlimited asset-backed securities based on subprime mortgages anymore, because this would influence their counterparties' credit valuation hugely.